Hi everyone, welcome to this month's financial markets update. July was another really solid month for financial market performance. We had both equity and bond markets moving higher over the course of the month. Our local equity market was up a tad over 1% for the month, and this was really driven by a significant uplift in the materials part of the market, which was up over 7% in July alone. And then bond markets also rallied pretty strongly as well. We saw a continuation of a decline in yields over the course of the month. At the back end of the curve, our 10-year bond yield was down around about 35 basis points. US 10-year was down around about 25 basis points as well. And so that continued on from what we've seen over the last couple of months, leading to some really quite solid performance in bond markets. And equally, we had solid returns in both global equities, again up roughly around about 1%, and REITs and infrastructure were also higher. The sector that really copped it in July was emerging markets, and that was down around about 4.5% over the month of July. And that was really driven by some of investor nervousness as it relates to the changing regulatory regime that we were seeing out of China, particularly with companies such as Alibaba, Tencent and the like being significantly impacted, along with the move by the Chinese authorities regarding the education sector as well. And so we saw a lot of the education stocks marked down as well. And so that resulted in Shanghai index down over 6% for the month, and the Hong Kong Hang Seng index down over 9.5% for the month of July. And that really flowed through then into broader emerging market equities, where China and Asia particularly make up a significant proportion of the overall index. From our perspective, when we look at some of those implications as it relates to the changing regulatory environment in China, certainly from our point of view, we don't believe that the Chinese authorities are really looking to clamp down to the extent that it's going to impact on overall economic growth over the medium term. But there is definitely a change in the direction from a policy standpoint that, from our perspective, we think is creating increased uncertainty as it relates to emerging markets in the medium term, short to medium term. On the back of that, we've actually started to narrow down our overweight exposure to emerging markets. We continue to like the thematic around the rebound, particularly in terms of the economic environment, and the valuation from our perspective also looks quite attractive. And we've got a chart here that just actually shows the relative PE valuation spread between Chinese equities and developed market equities. And you can see here on that chart that Chinese equities, as well as sort of broader EM, is at the lowest discount relative to developed market equities since the early part of last year. So, from our perspective, there is some significant valuation opportunities, but clearly when you're looking into emerging markets, and certainly if you're considering looking into Asian markets, particularly where China is obviously the dominant market, there are concerns there just in terms of what the changing regulatory environment means for individual companies. And certainly, as we've seen, some of those bigger name companies have really seen some significant declines in their share price over the last sort of month or so. So from our point of view, we just think it's worthwhile reducing some of that overweight exposure to EM as we get a better handle on what that direction in the policy framework looks like. But as I said, we don't envisage that the Chinese authorities are really looking to have such a significant clampdown that it's going to ultimately upset the growth profile. We do think there are some other elements at play on that basis. Equally, the rally in bond yields has been quite surprising from our perspective as well, certainly when you're looking at the inflationary environment more globally. We do believe that continues to be transitory. We do think some of the supply chain bottlenecks that we've seen and continue to see, we think some of those prices that have occurred, the price rises that occurred in parts of the market, we think are going to be quite sustainable. Even when we work through some of these logistic problems that are clearly impacting supply chain globally. And from that perspective, we think that the inflationary environment actually might start to pick up, and it might actually be higher through the cycle than what has been anticipated potentially by market participants. It doesn't change our thought process around the fact that central banks are going to continue to be very cautious in the way they look to change their monetary policy settings, whether it be through the tapering programs and or looking to raise official cash rates at a point in time. But we do feel that the inflationary environment probably has increased as we look at it going forward. And then on that basis, when we think about where 10-year bond yields are at locally, it's sort of roughly around about 1.2% globally, not too dissimilar to that. We just don't feel that its inflationary pressures and also the growth rebound that we continue to expect to come is being adequately priced in. And so from that perspective, we're continuing to look at our fixed income exposure, particularly as it relates to global aggregate benchmarks, and obviously in terms of the types of strategy we've got. And our valuation metrics point to bonds being still at their most expensive levels that they've been over the last 10 years or so. So we remain underweight in that part of the market and continue to be so, albeit that, as I said, the last sort of 3 months we've seen some positive numbers given the decline in yields. But from where it goes here, we feel that it's going to be pretty hard for yields to move materially lower, given the rally that we've seen in the near term. Elsewhere, we continue to have a focus on having that growth exposure across our portfolios. We continue to believe that the growth environment is in place. Clearly, the Delta variant is creating its own challenges, both domestically and global. And as I said, I think that's been most overt in terms of the supply chain challenges that we've seen around the world. But ultimately, we continue to believe that the growth outlook over the medium term remains relatively sound, and we think that's clearly positive for growth assets particularly. As always, if you have any queries or concerns about your portfolio, please feel free to reach out to anyone in the team, and we look forward to catching up again soon. Thanks, and bye for now.